So guys, welcome to VRD Nation. Through this channel, we are trying to educate our fellow investors and traders on every topic that pertains to investing and trading using real life examples, case studies, real life trades, animations, right? So we're trying everything that we can to make things simple. So if you're here for the first time, you're hearing me for the first time, do not forget to subscribe. So guys, in today's video, we will understand a very important topic called mean reversion. And first of all, I will explain the concept and then I will show how mean reversion based strategies can be applied in real life. And for that, I will take an example from today's trade. So everything is fresh in my mind. So I can explain how I applied mean reversion strategies and made some money from it. All right, so let's get started. So we'll start with, first of all, breaking this phrase down, right? So mean and reversion. Mean refers to average, and reversion means going back. So mean reversion refers to the phenomena of stocks or indices returning back to their averages if they have moved far away from them. And so that's the definition of mean reversion, but let's understand mean reversion from a very practical standpoint. So let me give you an example of that. So let's say on an average, it takes you about 1 hour to go from your home to office. Now, of course, depending on the traffic conditions, sometimes it can even take longer, like 1.5 hours. Or sometimes you can reach in a very short period of time, let's say half an hour, right? But the average, the mean, the most likely duration would be somewhere around 1 hour, right? Now, let's say one day you got stuck in a bad traffic jam, something unusual happened, some accident or something, right? It took you about 2 hours to reach your office. Now, does that mean that from that day onwards, you will plan for 2 hours of commute from your home to your office? No, right? Because you know that exceptions happen, we cannot plan for these things. So eventually life will go back to normal, right? In the same way, stocks tend to trade around their mean valuation, but every once in a while, due to some news flow or some market event, they keep moving away from the mean. Now, in case of a positive news flow, the stock can jump very quickly. It can go up, let's say 10%, 20%. And similarly, in case of a negative news flow, it can come down 20%, 30%, right? But just like those extreme traffic conditions, these moves turn out to be temporary and the stock eventually returns back to the mean, and hence the term mean reversion. So a mean reversion strategy relies on a stock or index to go back to normal, right? So if a stock has gone down a lot, people will expect it to revert back to the mean. Means traders will expect it to go back up, so they will take a long position. And similarly, if the stock has gone up a lot, then mean reversion traders will take short positions because they expect the stock to come down towards the mean, right? Now, let me take a real life example to explain this. So guys, the concept of mean reversion can be applied on different time frames. It can be applied on a weekly time frame or a daily time frame, as well as on a intraday time frame. Now, as far as I'm concerned, I like to apply that on an intraday time frame because there is a very good reason for that. So I believe that on a day-to-day level, there is nothing fundamentally changing in the market, right? So of course, the companies, they report their earnings every 3 months and there is occasional news flow here and there. But if you see from a day-to-day level, right? So from previous day till today, what exactly has changed in the market? Not much, right? Most of the time we are either reacting to the global cues or local cues or some kind of a news flow. So mean reversion strategies for me work better on a intraday time frame. And a perfect example of that would be today. So if you just draw a line in the middle, let's call it the mean, right? And let's see what happened. So the market gapped up and then it gravitated towards the mean, right? Then again, it went away from the mean, but slowly, gravity pulled it back towards the mean. Again, this gyration, it just kept going up and down, up and down, up and down. But most of the time, this mean acted as an equilibrium price around which the market moved throughout the day because there was nothing meaningful that was going on in the market. There was nothing substantial that happened in the market which would have made the day a trending day where the market would have, let's say, just gone up and up and up or gone down, down and down. So when you have a market like this and then when you combine that with options, then you have some very good strategies where you can make some easy money. And today is a perfect example of that. So as you can see today, I took both long trades and short trades. So when the market was away from the mean on the upside, I took short trades on the market. And when the market was away from the mean on the downside, I took long trades on the market. And eventually, as you can see, of course, here and there, some of the stop losses keep getting hit. But on and all, what ended up happening was that I made money from both sides, right? From the long side as well as on the short side. So this is the essence of a mean reversion strategy. You identify a mean and look for opportunities where the market has gone far away from the mean, and that gravitational pull that the mean has on the market price, which just keeps pulling and pulling and pulling, that gives a beautiful trading opportunity. Now, having said that, I want to say that mean reversion, it works well on days like this, but then there are days where mean reversion doesn't work, right? So the example that I took was if the day happens to be a trend day where there is a very clear reason for the market to either go up or go down. And of course, on days like that, if you apply the mean reversion strategies, you can incur a big loss. So that is why it is important that you as a trader, you have to use your experience, your knowledge, your instinct to figure out when a specific strategy has to be applied, right? So there is no substitute for that. You cannot just blindly take one strategy and apply them every time. Anyway, guys, I hope that this video would have given you a decent perspective of what mean reversion is as a phenomena and how professional traders apply that in real life.